What if I told you that you could earn double-digit returns from real estate without ever owning a single property? No tenants, no toilets, no 2 a.m. maintenance calls, no contractors, and no chasing rent payments. I'm going to walk you through exactly how I do it, and I'm going to use a real deal I did on a fire-damaged property in Georgia to show you both the upside and the things you give up when you invest this way. Because here's the truth, it's not perfect. But for high-income professionals who want truly passive income, it might be the best kept secret in real estate. If we haven't met yet, hi, I'm Andrea. I work full-time in the pharmaceutical industry. I travel constantly for my job, and I invest in real estate on the side. And real quick, before we get into it, if you're building wealth alongside a W-2 career and you want strategies that actually work for your real life, not some quit your job fantasy, go ahead and subscribe, because that's exactly what this channel is about. Okay. So real estate without being a landlord. When I first started investing, I thought the only path was to buy property, find a tenant, manage the thing. And I did that. But I quickly realized that didn't fit the lifestyle I actually wanted. I didn't want more jobs. I wanted more freedom. And that's what led me into what's called private money lending. In this video, I'm going to break down what it actually is, how it compares to owning rentals, the real pros and the real cons, including a deal I personally did that illustrates both sides perfectly, and how you can get started if you're brand new to this. So what is private money lending? Let's just simplify this completely. Private money lending is when you become the bank. Instead of buying a rental property yourself, you lend your capital to another real estate investor, usually someone flipping a house, stabilizing a rental, or funding a development project. They use your money to do the deal, and in return, they pay you interest. Your loan is documented with a promissory note. It has a defined repayment timeline, a deed of trust, and in most cases, it's secured by the actual property. We really want that to be the case. So your money is backed by real estate. You're just not the one managing it. Instead of dealing with the operations of a property, you're earning income from financing the deal. And that one shift from owner to lender changes everything about how passive this actually is. I want to make this real for you, so let me tell you about a deal I did in Georgia on a fire-damaged property. Because this one example shows you the best parts of private lending and the honest downsides of private money lending better than anything I could explain in theory. I lent $50,000 in first position on this property, and I want to pause on that number for just a second. I said $50,000, not $5 million, not even $500,000. Because one of the biggest misconceptions people have about private lending is that you need a massive amount of capital before you can even get started. You don't. $50,000 got me into a real deal in first position with monthly payments coming in. So keep that in mind as I walk you through this. The property had fire damage, but even in its damaged state, the as-is value was above my loan amount, which meant I was already protected before anything even happened. That's what first position and proper loan to value mean in practice. Your capital has cushion underneath it from day one. Every single month, I received interest payments directly to my bank account. I didn't manage anything. I didn't make a single decision about the property. I just received the monthly payments. Now, the deal did go a little late. The borrower needed a little more time than originally planned. And this is where I want to be real with you because that can feel a little unsettling when it happens. But here's the thing. Because my loan was well secured, because the property had real value, and because the borrower had strong margins built into the deal, that delay was a bump and not a crisis. I kept getting paid, and eventually they sold the property. And here's where it gets interesting. That property sold for $597,000. Let me let that land for a second. $597,000. My return, double-digit interest on my $50,000, truly passive, monthly, and honestly very secure, because the appreciation happening on that property was exactly the cushion protecting my position and my principal that entire time. But here's the honest trade-off I want you to understand. I did not capture any of that appreciation. That $597,000 sales price, none of that upside came to me. The investor who bought, held, flipped, and sold that property made serious money. That was their reward for taking on the risk, managing the project, making the decisions. My reward was predictable, passive, double-digit returns with my principal protected. And you know what? That's actually the whole point. As a lender, you want your borrower to have a big upside. You want them to make great money on the deal. because that margin is what protects you. The bigger their profit potential, the more room there is for things to go sideways without your loan ever being at risk. That appreciation opportunity I missed out on was actually working in my favor the whole time. It's what kept my $50,000 extra safe. And that is why investors will pay double-digit interest rates to borrow from private lenders like us. We're not the ones taking on the project risk. We're not the ones swinging the hammers. We're not the one managing contractors. We're the ones providing the capital that makes the deal possible. And we get paid consistently and predictably for it. So let's talk about what makes private money lending genuinely compelling. The first thing is predictable returns. You know your interest rate before you fund the deal. You're not hoping appreciation happens or that the rental market stays strong. Your return is contractually defined. That creates a level of clarity and planning ability that's hard to find in most investments. The second is that it's truly passive. And I mean that in the most literal sense. Like the Georgia deal, money went out and then monthly payments came in. I did nothing in between. There's no property manager to manage, no leases to renew, no maintenance calls. For someone with a demanding career, that matters enormously. The third is that your loan is secured by real estate. You're not making an unsecured bet on someone's business idea. There's a physical asset that's backing your capital. That's meaningful protection when you do your due diligence properly. And fourth, many of these loans are short-term, 6 to 12 months. Your capital isn't locked up for years and years waiting for equity to build. It can cycle back and go to work again relatively quickly. And now the honest part, because I'm not going to sell you on this without being real. The biggest thing you give up is appreciation. I already showed you this with Georgia. That property sold for $597,000 and I didn't see any of that upside. If you're someone who wants to build long-term equity and ride market appreciation, owning property is still the way to do that. Private lending is not a path to equity in the same way. The second downside is that this is not a casual endeavor. You can't just lend money on a handshake. You need real documentation, promissory note, a security instrument, title work, insurance verification. If you skip that stuff, you're not investing. You're giving your money away and hoping for the best. Protect your capital with proper paperwork every single time. It doesn't matter if you've done a deal together before. It doesn't matter if this person has a long history of success. Every single time. And the third thing is loan to value. You never want to lend 100% of a deal's value. The reason that my Georgia deal was safe, even when it ran late, is because my loan was well under the as-is value of the property. That equity cushion is your protection if something goes wrong. You need to understand the numbers, not just trust the person. So how to get started? If you're brand new to this, here's how I'd approach it. Start by building relationships. The best lending opportunities come through your network. Local investors, meetups, masterminds, referrals, not random DMs on Instagram. You want to know the people you're lending to and understand their track record before you put money in. Start with a smaller amount. Your first deal doesn't need to be 6 figures. Getting one deal done and understanding the process from start to finish is worth more than chasing a big return before you know what you're doing. Build your confidence before you build your scale, and learn to ask better questions. What's the exit strategy? What's the borrower's experience level? What's the after repair value? And how does my loan compare to it? What's my collateral position? What happens if things don't go according to plan? The investors who protect their capital are the ones who ask these questions before they fund and not after. Private lending changed how I think about real estate investing entirely, because I realized I didn't need 20 doors in a property management company to create cash flow. I needed income that fit my actual life. The Georgia deal is a perfect example. $50,000 out, monthly interest payments in, fully passive, double-digit returns. And yes, I didn't capture that $597,000 sale, but my money was protected by that very upside the whole time. Sometimes the smartest move in real estate isn't owning the property, it's owning the paper. So if you're a busy professional trying to build wealth outside your W-2 without becoming a full-time landlord, private lending may be your best next step. Drop a comment below. Would you rather own the rental or be the bank? I genuinely want to know where you stand on this. And if you want more strategies on building wealth through real estate and creative finance while keeping your career, subscribe, because that's exactly what we talk about here on this channel. I'll see you in the next one.